No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. Lots of good news out there today. We've got a jobs report that came in. The expectations, according to the economists, was that the unemployment rate was going to go up to almost 20% and that we would lose another 8 million jobs, which would be, I think, a total of close to 30 million jobs lost altogether through this pandemic that we've been dealing with. In reality, though, that's not what happened, is it? What we see, in fact, is that the unemployment rate dropped. Instead of going up to 20%, it dropped to 13.3%. Instead of losing 8 million jobs, we actually gained 2.5 million jobs, including a nice increase in manufacturing. So this is excellent news. Expect to see the futures, of course, are responding well to that. They were up positive before the news and expectation, and up even more. So we look like we're in for a good day in the market today. And but it's even better than that, right? When we look at the market year to date, the S&P is only down now about 4%. So when you think of the drop from the peak to the bottom in March 23rd, I think it was February 19th of the peak, we lost 34% on the market just in that month, basically. Now, we've regained most of that just in the time since then. So just in the last couple of months, basically, that we've seen, about 6-7 weeks actually, that we've seen this kind of a rebound. Now here's the other. If you look at 1 year ago, and we're looking at, when you're investing in the market, of course we're long-term investors and we're looking much longer than that. We're looking basically over our lifetime. For retirement, we're thinking those retirement years, how do you change the way you invest? Well, or do you change the way you invest? There are some considerations now when you're accumulating money and you're just pumping money into your accounts. How you invest at that point may be more aggressively, likely is more aggressively, than what it will be when you start taking money out of those accounts. Now what that means is how you structure your portfolios. We're going to get into that in some detail today. I've talked over the last few weeks about how to, in fact, invest in the market, how the smart money invests. The academic research that we have, 60 years of Nobel Prize winning academic research, showing us, in fact, how to construct a portfolio, showing us the principles of investing and get away from some of these myths that are out there of what may work. All right, so we've talked about, for instance, stock picking and market timing, and how those can set you up for losses in the market, basically for getting a lot less return. I talked about Dalbar's report, for instance, showing how people that invest, the average investor in the market, get about 1/3 what the market's return is, and it's mainly because of these myths, because they're trying to time the market. So they're pulling out at the wrong time, they're jumping back in, they're missing out on returns. Same thing with stock picking, thinking that they, somehow that whether they're doing it themselves or following the advice of an advisor who supposedly has some crystal ball as to which stocks in the market are going to do better than others. What we've learned, in fact, the reality is it's about indexing. It's about buying the market and how to do that. So when we look at the S&P as an example, right, the 500 largest companies in the United States, they make up about 70% of all the money in the stock market, outperform 90% of all mutual funds. And if you look at that, even on those 10% that beat the S&P, it's not a consistent, it's not like, oh, there's the best ones. No, because it changes all the time, right? And if someone just got lucky and had the right mix of assets at the right time, and they may have beat the market for 1, 3, 5, maybe even 10 or 20 years, but we're looking back at what they did, and when we look forward after, we see that they typically underperform. So what we've learned, again, is about indexing and how to buy the market. This is how the smart money invests, and one of the things that we're going to get into today is how to apply that again for you. And that's what we've talked about over these last few weeks, how to construct that portfolio. Today I'm going to show you some of the results of that. So when you get into the S&P 500 index, as I mentioned, if we go back a year from today, so in the last year, if you got in the market 1 year ago as an example, you would have earned 10%, right, made 10% on your money in the past year. So when you think about the volatility and the naysayers, and you think of how negative and pessimistic people have been through this year, 2020, up to this point, we understand that. We had a pandemic. It had something to the degree that we stopped our whole economy. Nothing like this has ever happened. And what the expectations are, you have those thinking that it's going to take years to recover from that. Well, what does that mean exactly? What we may see, in fact, is what others are saying, and the more optimists which are saying that we're going to have more of a sharp recovery, and that by the end of the year in particular, we're going to be in very good territory. And the way things are going at this point, that recovery could be happening even faster. Now, having said that, okay, I want to encourage you to look at what you're doing, what your plan is now. This is a great time to revisit your asset allocation. If you've been staying the course and you've got a good plan, and you're well diversified as far as your portfolio, excellent. That's what we're looking for, right? If you've been nervous about this, if maybe you've taken money out of the market, or you're just scared or afraid to get in the market when you've had some resources available, then this is a great time to revisit that and look at what your asset allocation model looks like. The other part, even if you've done well, are you still managing risk? Do you have hedges in your portfolio to help you manage the risk in that portfolio? Because there are other factors than, let's say we're past the worst as far as the effects of the pandemic and that our economy is going to start gearing up again. There are other factors that are going to come into play this year, both in the rest of the world as well as here domestically. We've got an election coming up. What may be the results of that? How might that affect the market? So we still need to have hedging strategies, ways to manage risk in our portfolios in place, so that if the market goes down, you're still well positioned and you're going to be protecting yourself. You're going to be managing the risk to minimize it while still seeking those market returns, so that if the market goes up, you're going to benefit from that as well. That's what good asset allocation is about. It's about how to manage a risk, right? Remember the efficient frontier we talked about with Dr. Harry Markowitz designed, and showing how when you put together a portfolio in a particular way that you can in fact get that market return, but you can cut your risk in half. That's the kind of things we've been talking about, and I'm going to share some more with you today, as well as some strategies. So again, when you're taking money out of your portfolio in retirement, it does require that you change your investment strategy a little bit over that of just a growth strategy. We have to now account for income, and as we're pulling money out, if we're too aggressive as we start selling shares, let's say in a downturn, we're selling those shares really cheap, and now when the market goes up, we have less shares, we're not going to recover as quickly. So we need to put together in our planning a way to manage the risk, but also to, in particular on the income side, to where we're setting aside, say, 3 to 5 years worth of income in a different type of investment, not invested as aggressively. It may be, and we're going to talk about different strategies actually to do that. If you would like, by the way, to learn how to do these things, I'm sharing a lot with you, and of course try to give you as much good information every week as I can. But maybe you need a more personalized approach. Maybe you need to say, well, what about my situation? I see how these things work, but would a raw strategy work for me? And my asset allocation modeling, is it done correctly, or are the ways that I can improve upon it? Well, if you want to call my office, the number is 615-376-5325, and what we'll do is a comprehensive financial plan for you at no charge. This will allow you to in fact see your financial future based on the things you're doing, and then share strategies, specific strategies, not all the general ones I throw at you every week, but specific strategies for your situation. A big part of what I try to do each week is bring information to you that will help you learn, right, to become a more informed investor, to be better prepared for all the complexities that go with retirement, and whether it's investing or Social Security or Medicare, all the different factors that come in. Share information with you to help you basically know what to look for and how to make some changes. But again, for a more personalized approach, if you'd like a personal financial plan, comprehensive financial plan done just for you, call my office at 615-376-5325. Tess is standing by. She'll give you, she'll take your information. She'll send you out a checklist of things to bring to your appointment with me. So we'll look at your income, your expenses, your assets, your liabilities. We'll factor in for inflation and taxes, rates of return on your money. We do all of that and can show you then your financial future based on what you're doing today, whether there's a likelihood of, or a potential even, of running out of money, what type of income you can safely take from your portfolios without that worry. We also, in that investment analysis, get into looking for, is there any little traps, if you will, or great risks for you in your current portfolio given certain market conditions that could set you back, and show you ways that you can protect yourself against that. And then also strategies for income. We can share with you a number of different things that we get into with that part, because that's a big one when it comes to, in fact, I'm going to talk about after the break, 3 common income generating strategies to help you, in fact, when it comes to that piece in retirement. Again, remember that 3 to 5 year piece that you need to have a strategy to avoid market volatility for that money in particular. So we cover it all. So if you'd like to get that free comprehensive financial plan, 615-376-5325. As I said, Tessa's standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, we're going to take a break. Join me here. We'll be right back on the Retirement Report.
This Storm 5 weather update is